Today's topic for the property and casualty exam is how property is valued at the time of a loss, focusing on the key concepts of actual cash value and replacement cost. The most fundamental concept the exam will test you on is the difference between replacement cost and actual cash value, or ACV. Replacement cost is straightforward. It's the cost to replace a damaged item with a new one of similar kind and quality, without any deduction for depreciation. Actual cash value, however, is the replacement cost minus depreciation. The exam loves to test this with calculation questions. For example, a fire destroys a 5-year-old sofa. The new comparable sofa costs $1,000, which is the replacement cost. If the sofa has a useful life of 10 years, it has depreciated by 50% or $500. Therefore, its actual cash value is $500. Remember this simple formula. Replacement cost minus depreciation equals actual cash value. An easy way to remember this is the phrase ACV always costs you, because you're getting less than the full replacement amount. Now, let's discuss other valuation methods. Market value is what a property could be sold for, but it's often irrelevant for insurance because it includes the value of land, which isn't insurable. The exam might try to trick you by including market value as a distractor option in a loss settlement question. For unique, hard-to-value items like fine art or a classic car, policies use an agreed value. This is an amount that you and the insurer agree the item is worth when the policy is written. If a total loss occurs, the insurer pays this exact amount, avoiding disputes over value. A common exam trap is confusing agreed value with stated amount. A stated amount policy lists a maximum amount the insurer will pay. However, at the time of a loss, the insurer has the right to pay the lesser of the stated amount or the ACV. So, unlike an agreed value policy, a stated amount does not guarantee you'll receive the full amount listed. Finally, there's salvage value. This is the value of the damaged property after a loss. For instance, if a car is totaled, the insurer might pay the claim and then take ownership of the wrecked car to sell it for scrap or parts. The amount they get is the salvage value. If the insured decides to keep the totaled vehicle, the insurer will deduct the salvage value from the claim payment. Be prepared for questions that test these distinctions, especially with older property, which is typically settled at ACV, versus collector property, which is better suited for an agreed value policy. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.